Hello out there. My name's Glen Mather. I'm the founder of NuView Trust, a custodian for self-directed IRAs and 401ks and other things where we don't want to have to pay taxes before we actually owe them. But so in a series of talks about alternative investments, I decided today to talk about single family rentals. And I didn't realize that markets call this their own unique asset class, and it's SFRs. And there's actually groups and not just seminars, but actually conventions all around this type of asset.
Right.
And I've actually attended one of these in Dallas for several times, called the 5-Star Conference. And it's there I learned about there's a lot of money that's in single family rentals, far more beyond the single, like one person owns one.
Right.
But yet about 70% of individuals just that are in that space only own one.
Right.
So when I get a chance to meet and talk to somebody who treats this more like a business and has more of these, I want to talk to them more, and I decided to do that on camera. Mm-hmm. And this is Mr. Earl Savage with me. And Earl's an amazing individual, but I'll let you come to that conclusion on your own after you hear what he's got to share with you. But I know that Earl is very much heavily invested in single family rentals. And so we're going to learn a lot together, Earl.
Yes.
And I really look forward to doing that. How did we first meet?
I guess we actually first met when maybe you had one of your planning for prosperity. Or no, actually way back before then. Oh, maybe it's CFRI.
Yeah. I mean, what is CFRI?
Yeah, Central Florida Real Estate Realtor Investor Group.
That's a long name.
Right.
What does that group do?
We actually so it's a group of like-minded individuals, investors who have an affinity for real estate investment, both single family as well as flipping properties, as well as wholesaling properties. So we are a group that has a common goals in mind in real estate investing of various types.
That's interesting. Are those tend to be in other cities, or is that unique to Central Florida?
Yes, there are real estate investment groups in most major cities across the U.S. and in Canada. So a lot of times real estate investor clubs or groups get together and they share ideas, bring in experts in certain fields, certain categories that would be educational for new people in the business, as well as seasoned investors in the business.
Okay, so they could Google that wherever they are,
Yes.
where they're located.
Right.
Well, you're a relatively young man, so you probably don't have a long history, but whatever history you have, share it with me and the audience as far as where'd you grow up and how did real estate become part of the fabric of your life?
Right. Well, I grew up in a little small town in eastern Arkansas with my father, my parents. We have a farm there. So I grew up as a farmer in middle school, high school. I was working with my father, managing and running the farm. So I became the manager of the farm at 11th, 12th grade.
Wow.
And everybody thought I was going to continue the business there. But my father encouraged me to go to college and pursue another career field. And so I did. So I went off to college and got a degree in electronics. And end up working at a minor in architectural design. And I think that minor in architectural design afforded me a lot of opportunity when it comes to real estate investing and knowing what designs of structures and houses and those kind of things. But I worked a career in electrical engineering design for a major aerospace company.
Did you stay there or did you move out of your hometown?
I moved out of my hometown. When I graduated college at University of Arkansas,
okay.
A little town called Pine Bluff, Arkansas, just outside of Little Rock is where I graduated college. Then from there, I went to Wichita, Kansas to work for a large aerospace company, the second largest aerospace company in the world, for a couple of years out there. And then I came to work for the largest aerospace company in Orlando in the 80s, early 80s.
What was the name of that firm?
It was named Martin Marietta when I came to town.
Okay.
And then it eventually became Lockheed Martin.
That's really interesting because my 13 years of employment right after college was at Lockheed. I had no idea that we had that.
Yeah.
So you came from Martin and I came from Lockheed,
right.
and now the companies are joined. That's funny.
Yeah.
Talk to me about how you got started investing in real estate.
Well, that's a funny thing. I came to Orlando in the early 80s, as I mentioned, and I was just going to stay here for 1 year. But after being here for 1 year, I saw so many people moving here, and the values of property was going exponentially very fast. And so I decided that real estate would be a good investment here in Orlando. So I bought my first home to live in, and then as a young man, and so I met my wife here in Orlando. She's from Orlando. So we got married. So I converted my first home to a rental, and that worked out very well. So
let me pause for a moment, because I've heard it said before that people get really excited about real estate and they buy their home and they think they're done.
Right.
Is your home that you live in an investment, really?
I looked at it as an investment, and that's it is an investment. Whether you live, a lifetime in it or not, at some point, maybe become an inheritance of property for your descendants, but it's still an investment. I look at it as an investment.
Okay, but it doesn't make money from you until what?
Until you sell
or rent
trade or rent it.
You said that you started renting it out.
Yes, I started my very first home I bought in Orlando. I still own it. I rented it out, when my wife and I got married. So I converted my first home to a rental. And from that home, I was able to generate 2 additional homes.
So explain that to me. So, because I think that this is where a lot of people that I've talked to in real estate get started. They start by actually moving out of their first home.
Right.
And instead of selling it, which is what a lot of people do, right? So they buy it, they sell it, they get excited because they made $20,000.
Right.
And then they turn and realize that I'm going to have to use that $20,000 because everything else I buy has gone up.
Cost more.
Right?
Yes.
So the way you get off that path is you actually rent it out and go buy something new. Is that what you did?
That's what I did.
So how did you actually you mentioned that you took that rental and you made it actually worth more rentals.
Right.
How does that whole process work?
I took it back during that time, early 80s, the bank would give you cash out. So I refinanced that first home and pulled equity out. And I took the equity and bought a second, actually a third home, but say a second investment property. I bought it from a wholesaler and updated it, just cosmetic, paint and carpet, with the equity from the first home. Then I turned around, refinanced that second investment property and took the equity out of it and bought a third investment property.
Okay, so what I want to do is not leave anybody behind on this conversation.
Yes.
You use the term wholesaler.
Yes.
What is that? What's a wholesaler, and why is that important in your journey?
Wholesalers are very important. If you don't have a lot of time, like I did not at that time, and still don't have a lot of time.
Because you were working as an engineer, right?
As an engineer.
Yeah.
So I didn't have time to search the marketplace for the right investment property. So I relied on wholesalers to send me their wholesale properties they have under contract.
You mean to tell me there's people that wholesale retail homes? I think people of wholesalers are people that work for a manufacturing company. Right. And they go sell it to big stores, and then the big stores sell it to the individuals. Right. That's what I understand a wholesaler to be. How's that work in properties?
Similar concept in properties. The person buys it at a as is condition, usually at a lower price point.
So these are in rough shape sometimes.
Holes in my very first investment property I purchased after converting my home to a rental. My first investment property, all the drywall had holes in it, roof was leaking, a carpet shop, everything needed to be cosmetically updated.
So why'd you buy it?
I bought it. It was a very good price.
So it was the pricing.
It was a very good price. So the wholesaler just bought it, got it under contract. So I bought his contract.
But that sounds dangerous, because what happens if it looks really good deal? And I've seen this happen with people, and then all of a sudden they add up all the costs and the plumbing and the electrical, it doesn't really work.
Right.
What did you do to kind of protect yourself against that?
I had a lot of education before that.
How'd you get that?
Through workshops, seminars, weekend classes, gurus coming into town. I would sign up for a Saturday, Sunday class and purchase books and tapes during that time. Listen to audio while driving to work, coming home in the evening, listen to audio, reading books. So I got to a level of education where I felt comfortable in doing it.
So many people in this business just plunge right in, because there is no requirement to have any sophistication to buy
Right.
rental real estate, and then they get, what happens to them?
They usually get in trouble. You know, they financially over pay too much for the property, or the repairs come and eat up all the anticipated equity.
So your recommendation is get the education. It's probably all around you.
Right.
It's probably on the web, right?
Oh, yes.
And it doesn't mean that you have to go attend a $25,000 seminar on whether it's Trump University or anybody else's university. You don't have to spend that kind of money, right?
That's true. Back during that time, I had to spend much more money, but nowadays it's all on the web, just like you're saying. But one of the fastest way to get educated is, you know, read and study and research yourself, but partner with someone else who has the experience, who has the education, and help them with their deal, you know, to learn a lot.
Well, I want you to tell people, and we're going to go through a lot more detail before we
Right.
finish this segment with you, but I want you to tell people how far you've come. How many single family rentals do you currently own?
I currently own, I think it's like 22 single family rentals. That's a combination of reason I'm hesitating, because some of them are multifamily, some of them are quadplexes.
So you have more on top of that, but they're
Yeah,
not single family
but not
rentals.
single family, right? So I have about 18 actual single family homes, standalone single family homes. Then the rest is condos, duplexes, one quadplex in a little town not far from here, Winter Springs, and then I graduated into apartments. So we have a 67 unit apartment complex. Started off with 48 units, and I added 16 units to it 2 or 3 years ago.
Okay, that's for another day.
Right.
I don't want to go too far down
That's-
into the apartment side,
Right.
because when you say, I want to take exception to one thing you said, because I think there's a tendency to this. You said you graduated, and I think there's a lot of people that get their masters and doctorates in single family homes.
Right.
So it's not like that's a lower level and
Right.
you get more sophisticated.
Right.
I think you can do, and I've seen people do really well on single family homes.
Yes.
And there's opportunities, of course, in multifamilies and lots of things. And we all understand the charm of duplexes where you
Mhm.
can live on one side
Right.
and rent out the other.
Side.
That's the exciting thing,
Yes.
Earl,
Yes.
is real estate investing can go so many different ways.
Right.
What was the appeal of real estate for you?
The appeal of real estate as an investment was I had more control. If my education was at the level where I was comfortable, I feel as though I had more control of the investment. I've only invested in stocks one time, and I lost.
Really?
And from that point, I never bought another stock. It was way back. And so I was able to control my real estate investments based on my education background and grace to a point where I was comfortable, you know. But with the stock market as an or other types of investment where you don't have hands-on, it's, in my opinion, a little bit more risky.
Well, let's talk about bankroll. For practical matter, that tends to, people feel like they're limited.
Right.
Like, I can't really do this. I don't have enough money. Property in Central Florida right now is going up.
Yes.
And so just when I start to save enough, it keeps going up.
Right.
So I can't really do that.
Yes.
Is there anything that you've learned through going through the process? How did you kind of deal with the financing? Was it basically that you stuck to your 9-to-5 job and your credit rating and your earnings there, you were able to take that to the bank and prove that you could buy that second and third property? Was that how you did it?
In essence, but the real reason that I was able to buy the second and third is I created equity. Yes, they looked at my credit standing, you know, good credit score and all that, and I did have not a full-time job, a W-2 job. They looked at that, but more so it was the equity that I was creating in the property is what the bank really looked at. So they saw that I was buying it at a certain price point, and I was going to fix it up with 10 or 15,000, and it had sufficient equity after that. So that's what the bank was looking at.
So in essence, what you're talking about is the banks are looking at a couple things. They're looking at your income statement, which is obviously part of your W-2 income.
Right.
If you're married and your spouse is part of that equation, hers too. But they're also looking at your balance sheet, right? So which is actually the value of the property that you have less any loans that you have on it. And they saw that that was growing.
Right.
Okay. Is a balance sheet better to look at than an income statement when you're determining how well you're doing financially?
Um, I like the balance sheet. That way you can see what your equity position is, and it also gives you another exit strategy. If you have sufficient amount of equity and maybe small on cash flow, well, then you have an equity exit strategy available to you to either sell that one of those properties or refinance it. But in today's market, it's hard for an investor to refinance and get equity out. But you have the option of selling, you know. But cash flow is key. I always tell any new investor, I do little workshops of my own from time
do
to
you?
time.
Okay.
Yeah, helping new investors. Yeah.
Well, there's
Answering
going to be a
questions.
whole lot of people maybe calling you at the end of this segment. They go, I want to learn more about that. So we'll
Yeah.
figure out some way to get people
Single family.
to
Yes.
find out about what you're doing.
Right.
But what are the Earl Savage laws of investing? So let's assume that you want to add to the 17 single family homes you own and add one more to it.
Right.
In today's environment, first of all, do you invest in Central Florida or do you go out of state and invest?
Central Florida primarily, single family.
So what would
we're
you
talking
single family
so Central
rentals?
Florida.
What would you consider maybe the top 3 or 5 things that you'd look for?
On a single family, if I'm gonna, there again, you have to make a decision whether it's a long-term hold or a short-term flip. So if I'm looking at a long-term hold,
Yeah.
single family rental, first I want to see what the rents are in that particular neighborhood of the property that I'm looking at. So I want a cash flow, at least if I can, 10% cash on cash return or better going into it.
Okay, explain that calculation that would arrive at a 10% cash flow. Just give us an
Okay,
example.
just a brief example, simple example. Well, let me back. I say like a CD. If you have 10,000, you put it in the bank. Well, we can just say they give you 10 or 2% interest rate on it, but that's
Not 2% today.
0.2. Okay.
No, it's about 0.5 for 5 years. That's how bad it is.
Right. Well, a CD, you buy the CD for 10,000. They give you whatever 0.2% interest rate. All right. So now that's your cash flow on that. Same thing with real estate. If I take the 10,000 and I invest it into a single family home, and then I refinance the balance of the purchase with a bank loan, well, I want to know, is the rent going to be high enough after I pay the first mortgage payment plus taxes and insurance? Am I still going to have enough remaining funds from the rent to give me a 10% return on the $10,000 that I put into the property?
So according to my calculation, thanks for making it simple enough that I can understand.
Yes.
But that would mean that you would need to get $1,000 back after you've paid all the expenses of holding the property, financing the property, the taxes, the insurance,
Yes.
and the maintenance.
Yes.
That you would be able to put $1,000 in your pocket.
That's annually though.
Annually,
Yes.
$1,000 annually.
Yes, yes. Which
Okay.
is only what, $85 a month, you know?
Sounds simple.
Yeah, right.
I don't think it's that simple, Earl. In today's environment, is it easy to find those deals?
It's not easy to find, but they are there. You have to look at distressed property. The property has to have some degree of warts
Yeah.
associated with it. You can't buy a retail home and make it a rental property and expect the cash flow in today's environment. It's just almost impossible. You almost have to buy it that needs a little bit of cosmetic fix up or a lot of cosmetic fix up, and then go through the numbers to make it work. Right.
Okay. So do I need to do this on my own? Can I partner to do it? Or can I buy into a fund that's a whole lot of these? So how passive can I be, but still get the benefits of investing in real estate?
If you have time, I recommend you be more hands-on, be more active, should I say. Sure, it's a passive investment, but you're an active participant. Learn the business, learn how to evaluate costs of repairs and things like that. Learn those things, and now you got a better understanding to be able to control that investment, to be able to get that return that you have targeted. So no, you don't have to do it all by yourself. I would say partner with someone else who
Explain what you mean by partnering.
Okay, so I said 10,000 in an earlier example. Say you have 15,000 or 20,000. We just say in a savings account for now. There's other instruments you may have. But if you have 10,000 in a savings account, you can't really buy a decent property for that amount. But there's another investor that you happen to know, maybe a member of an investor club, who is investing. So you put that money into the investment with the other partner, and whatever that return on investment that he's going to get or she's going to get, you get that same percentage of return on your $10,000. You know?
Yeah, Earl, you point out something I think that's been very valuable for me.
Okay.
And that is, since I opened NuView Trust 17 years ago, that's exactly how I've learned about investing and how I've learned about real estate is I partner with people.
Right.
The attractiveness of partnering, not just in real estate deals, but lots of other deals, is that I look at it like this. So Earl's right. If I show up with 1/3 of the purchase price and Earl shows up with 2/3 of the purchase price, the first thing is my name goes on the deed as well as Earl's.
Right.
And I go on the deed as 1/3 owner.
Right.
Earl goes on the deed as 2/3 owner, which basically means that if we get into any kind of big argument, the title is still that way.
Right.
Which means that if I sell it, if I want to sell it and somehow I'm able to compel to sell it, the title company that's going to close on the sale says 2/3 of this belongs to Earl.
Right.
So that like there can be no funny business between the two partners, right?
Exactly.
So I'm protected.
Yes.
But that has never had to be a problem for me. What I loved about it is being the minority partner, I learned everything that Earl does in the property. If I was to partner with Earl, he's likely going to take me to the house and look at it before we close. He's going to go down the list and say, this is the $15,000 that we need. And this is where I would estimate it. And here's the contractors that I'm going to bring in.
Right.
And this is what I think it's going to be worth at the end.
Yeah, exactly.
And we can partner short term, which is to flip it, or we can still own it long term.
Right.
And what's really cool is I point out, and we haven't gotten into IRAs or how they play into this, but what's great is my money can come from my IRA. It doesn't matter where Earl's money comes from. It can be his IRA or it just from his savings.
Right.
That's all allowed. So I've loved that. I've used my IRA and outside my IRA to really get smart about investments. So it's not just the fact that you may not have enough money. Maybe it's the smart thing that, yes, I'm going to go read books and go to seminars, but I'm also going to be able to find out someone who has high integrity that I'll partner with, because then I can kind of accelerate the learning, right?
And I'm doing that same thing right now. Even I'm partnering with another investor on another deal, and you know, you make an agreement up front, who's going to put up the money versus who's going to put up the experience and execute the project, execute the asset.
Yeah, I mean, there's another part of this, Earl, that I've not even talked about, and it's probably for another day, but joint ventures are really cool. What we talked about earlier was a simple partnership. We each put in different amounts of money, get the corresponding percentage ownership, and we go forward from there. Joint ventures mean that Earl may be offering up his expertise and getting a little bit more of a bump in that, or he may get more cash flow. We can structure that many different ways. We can do that inside an IRA or outside an IRA. And that's really cool, because no two individuals are normally at the same skill level or financial level. So you can tune it, right?
Yes.
Based on what they're bringing to the table.
Exactly. And you can do that. And if once you get enough experience and now you want to do it on your own, the whole one long term, I have several properties inside of my IRA that I've been as rentals for years. And so now you get the rental income off of it, and plus you're getting the appreciation inside your IRA. And oh, by the way, if I happen to sell one of those, I don't have to pay taxes because it's still inside the IRA.
But so hold on, you don't have to do a 1031 exchange if it's in an IRA?
No.
Why is that, Earl?
Because it's tax deferred. It's tax deferred. The gains or the profit is tax deferred until I receive the funds out of the account. So basically, the IRA account owns the property, not Earl Savage, but the IRA account owns the property. And so now whatever gain is made on the property or profit, it goes back into the account. So I grow my IRA account like that.
Yeah, it's pretty interesting because what you can do with a self-directed IRA, you kind of get to do with your IRA money the same thing you do outside your IRA. And there's times with real estate, it might make more sense to do it outside the IRA. You know, it's funny because, you know, CPAs, I'll meet with them and talk to them about self-directed, and they go, well, they go, well, sometimes it's more beneficial because you get depreciation. There's some other advantages about buying outside. I said, perfect, buy outside. But I'll tell you something, most people can't make those choices. You know why?
Right.
They don't have the same amount of money in their savings account.
Exactly.
Their money's in their IRA.
Right.
That's their only investable money. So the cool thing is that's kind of an esoteric question when you have two bags of money. But if you only have it in the IRA, most people view they're stuck with the market.
Exactly.
Like you said, you bought in the market one time.
Right.
I have no money in the market at all because I want to have something tangible.
Yes.
I don't want something run by some other CEO who can get into trouble.
Exactly.
And there's, we've seen it happen in the last year where entire companies are sort of being shut down, right? For whatever reason. It could be COVID, or it could be just basically the activities of the CEO may be something that put them in legal jeopardy.
Right.
And all of a sudden, all the money that you've invested in that firm that you thought was good is gone. That doesn't happen in housing, does it?
No, it doesn't. If you're managing the property yourself, if you control it yourself. Now that could happen in a REIT, a real estate investment trust or fund, where you invest your money into it, and then there's a manager that's buying single-family homes and renting them out. But I like to, there again, have my own experience, and I recommend anyone out there listening to get your own experience and own your own single-family home. Utilize managers, property managers, other investors to gain experience and knowledge, but learn to control the investment yourself.
But you do use managers, right?
Yes, for all of my single-family homes.
Why do you use a manager?
It frees up my time.
Because you could go do it.
It frees up my time. Anyone who first started out in the business most cases has more time. But if you've been in the business for a longer period of time, you accumulate more assets, more rentals, this rental, that rental. They take time. So you need to, I chose to hire a manager, a property manager. And now I can focus my time on finding other properties, or in my case, I flip properties as well. So I can focus my time on flipping some properties while my property manager maintains my rental property portfolio.
Well, let's be real about this. Most of the people that are watching this, they have a W-2 job.
Yes.
So they're not trying to figure out how to buy, 15, 17 single family homes. They're happy to get one single family rental, right? So for them, a property manager might make sense because they still have to go work at that engineering job at Lockheed Martin to give them benefit of, earning the cash, but they don't want to do this. So the reason why maybe you should have a professional manager is it's quite possible they might do a better job at it than you.
Exactly. And then it frees up your time and much better job. But I worked my W-2 job and I built up my portfolio while working the W-2 job. Probably maybe 8 properties while working the W-2 job.
So you weren't going home watching TV much?
No, not much at all.
But was that like a terrible burden on you? Did you feel like, do you look back at those times and say, I wish I hadn't done that work?
Oh, no. I'm looking at it as an advantage to us now, because many of those properties we bought, my wife and I, way back then, we still have several of them. And the advantage is the tenants are paying down the mortgage as I make the monthly payment and I collecting the rent. My mortgage balance is going down.
So that's the balance sheet issue, right?
That's the balance sheet.
So the asset becomes worth more and more. Even if the asset doesn't go up, you own more of it, paid by the tenant.
By the tenant. You're building equity as you go year after year after year. Even like you say, even if the rent doesn't go up or the property value doesn't go up, you're creating equity by making the mortgage payment every month.
I'm just curious. You talked about your first rental house, which was actually the first house you bought and you moved out of.
All right.
How much do you think you've made on that house since you bought it?
Oh, wow. That's a difficult question. I've had that since early 80s.
So there's no debt on it anymore? Or did you refinance it?
I refinanced it. So that's what I'm saying. I refinanced.
So it's probably bought you more other houses.
2 more.
Okay.
At the time, I bought 2. I converted my home to a rental, and my wife and I bought another investment property. So those 2 properties, I refinanced those twice and bought 2 additional houses. So that became 6 properties total. So from each property,
Yeah.
With 2 additional rentals. So that's 6 houses total from those 2 houses. And then
That's like following the DNA tree. It started with this, a little piece came
Right.
off over here.
Right. And then it kept going after that. And we got up to like about 12 houses, 12 single family homes. During that time, the banks will allow you to have, the limit was 10, but my bank allowed me to have 13, I think it was.
Well, this sounds all great.
Yeah.
All right. But I'm old enough. You're not as old as I am, I'm sure, but
Right.
I'm old enough to remember 06, 07, 08.
Mm-hmm.
There was a lot of people
Right.
that were really proud of all the real estate they owned.
Exactly.
And in Central Florida, they got cut in half.
Right.
The average value or the mean value of the properties
Right.
got cut in
Cut in
half.
half. Yeah, exactly.
So, and it took a long time for it to come back.
Yes. Yes.
So what about that? Maybe now, I mean, things are pretty hot here in Florida. I know my daughter bought an investment property
Mm-hmm.
and there were 9 bids on the property that she ended up getting.
Right.
Is there a time to stop? Is there a time to say, let's sit on the sidelines? What would be your advice about people that are looking, they're watching this in Maryland, Washington,
Right.
all over. Do you have the rule of thumb? Does it get back to the 10% rule that you talked about earlier, or when do you kind of let your money go in different places?
When the cost of property starts to get much higher, then you can get a decent return, whatever your threshold is for return. Mine is 10%. Some people maybe 6%. In my opinion, that's too low.
Mm-hmm.
You need to have at least a 10% cash on cash return or greater, just because of what you just said, the Great Recession hits. So when you have more positive cash flow, you can handle the reduction in the value and that kind of thing. But the interesting thing about that, most all of our portfolio was already developed before the Great Recession. Yes, the value dropped 50%, but the rent did not. The first 6 months to 9 months, my rent dropped $100. My average rent, I would say, was $1,100 at the time. My rent dropped down to $1,000 for the average at that time. That only lasted for 6 months.
So let me see if I understand that. So to a certain extent, even if you may have purchased a property in 2005
Mm-hmm.
and it was cut in value at the end,
Right.
you had made that decision to invest based on the cash flow
Right.
in 2005.
Right.
So in essence, you're really buying beds, aren't you?
Yes.
You're really buying beds, and you're not buying really high end stuff, right?
No,
you're not
no.
buying because they won't cash flow.
They won't cash flow.
So as long as you're in neighborhoods that are fairly safe, right?
Right.
You're not going into the real sketchy
expensive
places
Exactly.
or the expensive places,
Right.
and you're getting cash flow even when the market got clobbered.
Mhm.
What got clobbered was the people that didn't have the cash flow to support it, right?
Exactly.
And by making the right decisions and staying close to whatever that model is that you
Right.
constructed, and for you it's 10%,
Right.
you feel like that mitigates a lot of the risk of,
A lot of risk.
because things are going to go down again too, aren't they?
Yes.
Again?
Yeah, everything goes up and down at time. But that, I don't know what you heard when the first part of our discussion. I create equity. So you buy the home that needs repair, painting, carpet, those kind of things, similar minor repair, but you create the equity then. So now your cash flow is going to be upwards of 15 to 20% if you're getting at the right number. So now when the rents dropped, I was right at my mortgage payment, a little bit, still a little bit above.
So you weren't having to kick in some of that
I was not-
Lockheed Martin money.
No, I was
in
not
there.
negative cash flow. Only one property. Well, that's because I had already refinanced it prior to.
So you
I
had
was already
ratcheted it up,
Yeah, I had ratcheted it up.
but it
all
was
the
producing money to buy other
rest
properties,
to buy
right?
other properties.
Share with the audience. I want you to be real about the worst deal you made, and probably they've all been successes for you, maybe not, and the best deal that you've made in single family.
The worst one was when I I hate to even mention this, but when I purchased the wrong house, well, actually it was a condo. I purchased the wrong condo based on what was on my title work. Well, let me back up. I was bidding at a tax deed sale.
Oh, so you probably don't have a whole lot of due diligence before
Right.
that,
I didn't
right?
have a lot of due diligence time to do that. So I bid it on a particular condo, and I thought I went the day before to bid actually, and I looked at it, and the difference was it was um, it was a street name. The difference was avenue versus street.
Oh my goodness.
It was the same address inside the association. They have the same address, but one is avenue versus street.
That's so
I
wrong.
went and looked at the one opposite of what I was buying. It had a tenant in there, nice. I looked through the window.
Oh, you're going, hey, this
oh,
is
this is nice, right? Right. Already a tenant talked to me, told me how much they were paying for rent. Well, when I went the next day and I paid the money for the bid, and I went over there, and she had called her landlord. And the landlord, no, this is my problem. What? So I go to the association manager. She said, what street did you buy? And I told her I bought Avenue. She said, oh no, that property is on the street, not the avenue. So, oh God. So I go there. It was all boarded up. I couldn't even get in. So I called my repair guy. He banged the door open, goes in there. It was full of mold all over the place. I probably shouldn't say that to people if you're scared to invest now, but that was my worst one. But
it taught you what?
To make sure I'm looking at the street versus the avenue. Look real close at, really, you want to try to have time to do due diligence. If you're buying properties like that, that's for a person that has a lot of experience and have capital to handle those kinds of things. So, but in the end, I still even made $3,000 on that particular.
Well, I wish all my worst investments made me $3,000. What about your best one? What are you thinking?
Best one, I think that maybe the best one was probably, I guess maybe one of my first ones, like the third or fourth investment property I purchased. It was a foreclosure, pre-foreclosure. The person was already going through foreclosure. They had filed a lis pendens and had given them so much time to.
What is a lis pendens?
It's
don't go into too deep. But what's legal for
name
what?
that says that they've already filed a eviction against you. I mean, a foreclosure against you.
Okay.
And now in her case, that family's case, they had so many weeks or days to come in and.
So this is actually the bank that's saying,
yes,
I'm going to take over the title because you haven't made your payments.
And they give you another window of time, maybe like 3 or 4 weeks to come in and catch everything up.
Okay.
Including attorney fees and that kind of thing.
And generally that doesn't happen.
That doesn't happen.
Yeah.
Well, I ran into the family at that time. So, what they agreed to do will allow me to catch everything up, take over title.
And that way it doesn't hurt their credit rating,
right? Their credit. So I paid them, I'm thinking like $8,000, $10,000 or something like that, just cash.
Just to move them out.
Right. And then I was able to have them sign a quit claim deed that I did not record. That's key. Don't go down there and record it. So I took that to my attorney, and then the attorney did the background check, and then we say, yes, let's go ahead and go forward with it. And we'll record it at that point.
So this is an example maybe of you making money right when you purchased it,
Yes,
which had to do with it was distressed. Right. The owners couldn't make it up. They were concerned about really killing their credit. Right. I'm sure it was already damaged because they were late.
Yes.
But it's not as bad as a foreclosure on your record.
Exactly. So I was able to, all said and done after some renovations to it, and I put it back on the market and flipped it. In fact, that was one of my first flip properties back then, and made over 100% return on it. Based on the money.
That would be a good thing to do in your IRA, wouldn't it?
Oh, yes, exactly. No taxes, on the gain, right?
I have a couple more questions for you. How can I reduce my risk in doing this?
You said family investment.
Yeah, I think if I can kind of list a few things that I've learned by talking to you.
Right.
One of the things you said, you reduce your risk by being educated.
Yes.
Not trying to get in here. Number two, you reduce your risk by putting structures in place that say, I need to earn this much. Right. So you don't get like attracted to something that you shouldn't get attracted to because the numbers don't really work.
Exactly.
Right? Does that ever happen to you where you get a little bit excited about?
Yes. And so far I haven't gone beyond
my
limit, just being excited. It's almost like going to an auction. The next person bid and you bid, then you get all the emotions get into play. And that's the worst thing you can do, let emotions play. Because you're not buying a home to live in. you're buying an investment.
Okay. So what other things can I do to reduce my risk?
The thing, aside from education,
And
you can partner
partnering.
with
Yeah.
another individual, and then have an attorney or a title company do what we call a title search to make sure there's no liens and things on there that you can't find yourself. That'll come back and bite you in the
So
end.
don't try to do some of this stuff on your own. There
Right.
actually is reason to go hire other people.
Hire another person, and in particular, a title company to do the title search. That's the first and foremost up front. Even if you're buying it from a quote wholesaler, make sure you have someone to do the title search, because sometimes the wholesaler may not know about all the liens, and there's a certain lien that doesn't get recorded that could come back at you. So you want to have a title company do that search.
Yeah. And what's interesting, many people don't understand that and most of us have bought real estate with the help from the bank, right? We get a mortgage,
Right.
and the bank will always require you to get title insurance
Right.
because they want to make sure that their underlying asset that is protection for the loan
Right.
doesn't have a cloud of title or something
Exactly.
that can cause it to be valueless to the bank, right?
Exactly.
But when you're dealing with cash, you don't have to do that, right?
No, you don't
And
have to do it.
it's kind of your choice, and it might bite you and it may not.
Yes.
It's kind of like carrying regular home insurance, right?
Yes,
You
it
don't
is.
have to,
You
but
don't have to. I'm very conservative when I come to investing. I have insurance on everything. I get insurance. I have the title company do the title work up front, and then as I keep the property, I maintain. Even though it's free and clear, I maintain insurance. Hazard insurance on every property that I have.
what are the risks? Some of the risks that you can insure for, and the risks that you can't insure for in single family rentals.
I guess you can insure for major things like a fire or what have you. Those kind of things you can insure for those.
What about hurricane? What about sinkholes? What about lack income not coming in? What are some of the other things?
There's certain risk you're gonna have with the property regardless. You can put in safeguards. Like I said, for fire, even with sinkholes or even with hurricane, but it costs you so much in some cases to make the investment unaffordable. So you have to ask yourself, how likely is this investment gonna run across a sinkhole in this neighborhood that I'm buying when all these houses have been sitting here for years? So there's this degree of risk. I'm not saying it'll never happen, but I kind of segregate the risk. In other words, I'll take some risk.
Let me ask you this. Would you recommend this asset class for your mother who's already retired for her to hold? Would this make sense? Or does there come an age where, oh no, this doesn't make sense. I need to go run and buy an annuity or some other thing?
If she allowed me to analyze the property and look at it and determine whether it makes sense, yes, I recommend it to her, and get her connected with a good professional property manager and let the manager carry it on from there.
So it's basically anyone that kind of can think through. It doesn't have to be someone that's even ambulatory or can kind of go check under the sinks.
No.
If she knows someone that's licensed
Yes.
or a professional to do it,
Right.
why might real estate be a good choice for your mother?
Because of in the case if she's purchasing it out of pocket, out of savings, well then maybe there'll be equity appreciation over time for her descendants or children. She can put it in a will it to me if it's my mother. Or
Would that be
else.
any different if it was in an IRA?
No, wouldn't be any different. She could still will her profits as an IRA. In the IRA, once the property is sold and it comes out of the IRA to the descendants, well, then they would have to pay taxes on whatever gain that they receive at whatever tax rate they happen to be in.
And that's if they happen to sell it. If they happen to keep it, they could still get the cash flow and everything coming to them.
But the good thing about selling a property in an IRA, there's something that you avoid called recapture. You see, a lot of investors, when they're buying properties outside the IRA, I can take depreciation, I can lower my taxes each year. And, oh, by the way, I'm going to sell this property in 5 to 7 years. There's a little thing called recapture that a lot of people don't realize. And what I'm really saying is, it's a fancy word. The IRS is all they're going to say to you is that all the depreciation you took previous years that you offset your taxes with, Now you have to pay tax on that depreciation number that you took years ago. So it's a recapture. The way you avoid that is a 1031 exchange, or you have it inside of an IRA.
Yeah. So by having it inside the IRA wrapper,
Right.
you don't have to worry about
right.
that, man.
Right.
Um, how often do I have to reinvest? So if I buy something like this, is it a good idea to sell what I have every 5 years? How do I know whether I should flip it or hold it? I've heard of these controversies, and
Right.
why do you like to hold things?
Well, there again, if you have a strategy, if you want to be debt free, I kind of do 50-50. I'm under the pretense that you owe no one, not even the bank. So you want to have some free and clear property, and then you hold those indefinitely, and that becomes inherited property to your descendants. So now you don't have to worry about recapture or extra taxes. The other side of it is if you have properties in your portfolio and you see an opportunity to buy another property and the gain will be much larger than your gain you currently have, you sell that property, take the proceeds, buy this next one, and now you have a larger bump up in your total profit or gain.
Okay.
So that's the only way I would say that you want to sell it, unless you just want to take vacation and do trips or what have you. So that's an option also.
When you see people that have gotten in trouble, gotten over their head, made wrong decisions, what do you think is the cause of those?
A lot of time it's just lack of education and lack of research. Not knowing the market, not knowing what's the value of the homes in the market or what's the rents are in that market, and they get overhead. And then another thing is the repair costs. The repair to get it into rentable condition can really eat up your lunch. So there's a lot of things that can go wrong, but you can control those with education and partnering with other people with experience.
How much money do I really need to have to really, you talk about partnering, and if I had my IRA in this, what would I really take to really get started?
You can even start with IRA with almost any amount. If you have a small dollar IRA, but you almost compare, you don't have to partner with someone else, even another person's IRA. 2 IRAs or 3 IRAs to get together and buy one rental property, one single family rental. Or you can take your small dollar IRA and partner with one other person's IRA, and then those 2 IRAs own the property. And as you do that enough times, you're accumulating equity each time you sell the property. I would recommend that you flip a few properties starting out inside.
Oh, really?
Yes, because you want to create equity. You want to create cash. If you're starting out cash strapped, you want to do something to generate cash.
So it's hard to catch up just by the passage of time of earning 10%.
Yes.
It just takes too long. So you need those quick hits.
Yes.
That you might be able to find. I want to find some of those 100%
Right.
properties like
They're
you.
hard to find nowadays. This is way back, and it was a bank foreclosure.
Well, I got to tell you, Earl, this time has just flown by. It's been
Yes.
so much fun talking with you.
Same here.
Where would you suggest that people could learn more?
You can just start by internet searches on investing in single family homes, new beginning in single family homes, or join the local RIA group, real estate investment group, and just participate and talk with some of the people that are there, participate in some of the workshop they offer. And many of them are free of charge if you're a member, or maybe a little nominal fee for $75 or what have you, $50. And you can learn a lot there and mitigate a lot of your risk just by being around like-minded investors.
So is it a good idea to kind of really listen to people that have 5, 10, 15 properties?
Oh, yes. It pays dividends far beyond what you can imagine, trying to do it all by yourself. Yeah.
And can people contact you? Is that an available thing for you? I know that you're not necessarily in the business of training people, but I tell you, they're going to be pretty attracted to some of the wisdom that you shared with them today and want to learn more.
Yes, they can call me. Most people just need 1 or 2 clarifications on things, and I can answer those, or maybe 2 or 3 different phone calls. And now they are at a comfortable position, they can move forward. So
Well, maybe
I'm-
maybe rather than giving out do you have a email that you could provide to them?
yes, I have an email. That'll be better. Email address. You want me to give it?
Yeah,
now,
why don't you go ahead and give it right
Okay.
now, and then we'll
Post.
find some way to post it on the screen also.
Okay. Okay. Well, my name E Savage. That's ESAVAGE at CFL. That's Charlie Frank Larry. CFL.RR.com. So I'll repeat it again. It's ESavage at CFL.RR.com.
Well, I tell you, this has been a real delight to learn more about this.
Yes.
I see all these TV shows, but they don't get into all of this
Right.
practical stuff about what this life is like, and,
Right.
and you've lived it. I appreciate it. As always, all we want to do is inform my audience. We don't make recommendations about specific properties, but I'll tell you, I'm on fire for real estate.
Yes. Yes.
And but once again, it makes sense to be
Mhm.
educated. We at NuView Trust really look forward to you moving those funds away from the stock market,
Yes.
and all of the commissions and all of the charges and all of the downside of that into something where you get to make your own decisions,
Right.
and you have full control over those assets.
Exactly.
So until next time, once again, all the best in your investments.
It was a pleasure.
Thanks, Earl.
Yes.